Hi, guys, and welcome to the 39th episode of the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. All right, so let's begin. As usual, we start with a picture of the S&P 500. Red arrow denotes Monday, Tuesday, Wednesday, Thursday, Friday. Welcome to this new week, August 11th to the 15th. It's basically same as the old week. New boss, same as the old boss. So I'm going to get rid of the red arrow because it's getting in my way. But as you can see, there's basically no real difference to last week. It's exact same picture as before. We're going to touch upon some things that we looked at last week and then maybe have a trade idea in the end. Okay, so let's get started with our technical picture. That's the first thing that we always look at. So, same as last week, bullish. Nothing has changed. The bullish trend is intact. Not last Friday, but the 2 Fridays ago, it alleviated some overbought conditions, went back down, and now we're like, that was the RSI that I was looking at, the relative strength index, to show that we are still technically in a bullish pattern. Let's look at the moving averages. Yes, everything is trading above all moving averages, the 50, the 200. So no change, bullish. You should be net bullish overall. Okay, I still have some short exposure. Today, August was OPEX. August the 15th on Friday was OPEX. So a lot of that exposure that I had, some short exposure, expired worthless. It's okay. Some of it was put on for a credit, so I have no worries. The point is that this market right now is in a technically bullish position. Okay. However, we should note one little caveat here, okay, because we went into new highs this week. So technically speaking, if we look at the RSI, we have a higher high on the price action, but a lower high on the relative strength index. So that's like, we call that negative divergence. So you should make a note of that. We might be getting into a little correction soon. A little downward move soon, maybe, who knows. It doesn't have to play out. Okay, this thing could continue much, much higher, and this thing could like blast even higher. So just one little negative aspect on the technical picture of the S&P 500 is that we have that negative divergence that has formed as we moved into new highs. Okay, so now let's move into the sentiment analysis. I always like to look at that. We're the Fear and Greed Index, CNN, we're in smack down the middle of greed. Okay, everything is greed, momentum, everything, put call option, extreme greed. So greed, but not at extreme greed yet. We still have a little bit more to go. Okay, and what really shocked me, this is the big news of the day, of the week, is the AAII Investor Sentiment Index, which got even more bearish. So as we're going into new highs, people are getting more and more bearish. This is why I think this bull market has legs. People are still bearish, like we said last week, climbing a wall of worry. Well, the wall of worry got even more worrier, okay, by 3 percentage points. So it's not as high as 61.9, but this kind of bearishness is akin to the market falling 5%, 5-10%. Okay, and instead we went up like 1-2%, I guess. It's crazy. I've never seen that. That's why we are at huge risk of a melt-up scenario. Like we said last week, we switched to a bullish mode instead of a sideways choppy pattern for the summer. The summer proved to be our second scenario, which is a slow grind upward with low VIX, which is low volatility, which we're at lows on the volatility market. On the VIX. So you should still have some short exposure. I put on some short exposure that expired today. I put on some new hedges at a credit. So you should still be wary of a market coming down. However, I'm still bullish overall. So we might have a little, higher low that forms. I don't know if we'll retest the 613. I'm hoping we do. I'd still be bullish, but I'm hoping we do, but I don't think so. We'll see. September and October are very bearish months. Okay, so the sentiment analysis is very bearish, which bodes well for our net bullish outlook. Okay, so let's look at the macro that we always look at. Of course, we have, let's talk about the initial claims, which are the least of our worries here. Worries, quote unquote. In other words, there is no worry because we're at 224,000 initial claims. It hasn't spiked up, despite the fact that we had very, very bad jobs numbers last month. Okay, so nothing to worry about in the initial claims front. But the big news this week was inflation. CPI came in at 0.3%, which is in line. 0.3% is in line with what they were expecting, but it's still pretty high. Okay, and this is the core inflation. It's still staying very high. And if you see super core, it's much, much higher. It's like, 4 or 5%? I can't remember. But super core is pretty high. It takes into account services and all that. So there is services inflation and there is CPI inflation. But what came out on Thursday was the PPI, which was a surprise, which is the producer prices. So for a long time, we said that there's no tariffs, negative producer prices. Now there's 0.9%. Tariffs are starting to kick in. The inflationary tariffs start to kick in. So we have very high PPI. 0.9% is, let's see, 5-year average. That's pretty high. That's the highest since July of 2022. It's a big increase in the PPI. So producer prices are increasing at a high clip. So this is where the tariffs are starting to kick in a little bit. However, another shocking thing is that besides the AAII getting bearish, we have the Fed Watch tool. I'm looking at the September meeting of 2025 coming up. There's an 84% chance that the Fed cuts rates. It was at 97, but I guess with a PPI at 0.9%, it dropped to 84. That's still very high. Usually when it's above 75%, the Fed does whatever the market wants. So to me, the Fed cutting with inflation keep going. I mean, with inflation at 0.9% on the PPI and 0.3% on the headline and core, it's very, very strange. Because if they do end up cutting, like we said last week, the same scenario as last week. If they end up cutting at market highs, this is a melt-up scenario. We're going to see SPY 700, maybe more. Okay, and that's why this is very weird to me. Like this should have dropped like down to 50 and maybe like even 50-50 and even less. Like I'm telling you, if I was a Fed, I would not cut. Okay, this macro is telling me we shouldn't cut. But whatever, Donald Trump says he wants 300 basis point cut, a 3% cut in the short-term rate, the Fed rate, which would bring us down to 1% instead of 4.25%, which is nuts. Okay, this is crazy. You don't cut with markets at all-time highs. Okay, something is not right. Okay, so if the Fed cuts at these highs, I'm going to repeat it: rocket fuel. Okay, so let's talk about what interested me this week. Wow, tongue twister. Friday, TGIF. Okay, so not much. I mean, it's just basically a carbon copy of last week. So let's look at, well, we talked about inflation, so let's look at the 10-year rate. The 10-year rate is climbing. Okay, when you have inflation kicking in like that and the Fed funds tool still at 84% that we're going to cut, with a PPI at 0.9% that we saw earlier and CPI at 0.3, you're going to have rates stay high. Like the rates, you can't fool the long end of the curve. Okay, the Fed might be politically motivated to cut, but no, not the long end of the curve or the mid or long end of the curve. This is a market rate. Okay, this is set by the market. And the fact that it's high, meaning that it's telling you that the market still thinks inflation is a problem. They're not gonna. If the market thought inflation wasn't a problem and rates were going to go down to 1%, we would see the 10-year rate break this pattern, this level, and go below 3.5%. If we thought inflation wasn't a problem, okay. But the fact that it goes up, I mean, the melt-up scenario will keep this rate high. Okay, the melt-up scenario is the Fed cutting rates at all-time highs. I mean, the markets will go up, everything will go up, crypto will go up, all the crappy shit coins will go up, all the crappy shit stocks will go up, but rates will also will go up. Okay, it's going to be very bondholders will demand a higher rate to stave off the upcoming inflationary pressure. Okay, and what should have been noted is that the U.S. deficit grew to $291 billion in July. Okay, despite tariffs. So from CNBC. So the U.S. budget deficit grew by 20% in July alone. $291 billion. That's why you have rates at this level. Okay? Government spending is inflationary. Tariffs are slightly inflationary to maybe deflation, depending on how the economy does. But regardless, those price increases are being borne by importers. Okay? And that means that you're going to pay for it. Okay? So that's going to be very, very buoyant to yields. It's not going to make yields go down. Okay, so no matter how many times Trump jawbones and pressures, job bones the Fed and berates Powell, lower rates now, you're stupid, whatever. Like that's child's play. Okay, the market will not let rates go down in that scenario. So make that the note. And remember, the only snag that I see that will take down this market in the future is rates staying higher for longer. Nothing has changed. Rates staying higher for longer is going to eventually kill this market. Not right away, okay, but eventually it will kill it. We might have to go through that melt-up scenario first, which is going to be scary because the ensuing bust or hit after that, I shouldn't say bust, that's a stupid term, but the ensuing down leg after that will be huge, okay, because you're building up the excesses even more. But as of right now, stay long, bullish. Okay, this is a bull market. Stay with it. So to conclude, the market is telling you that inflation is going to be a problem eventually. Deficits are going to be a problem, and that's why rates are high. Okay. The other thing we should talk about is the gold, of course. We saw gold stay relatively stable this whole week, but let's touch back on the fact, on the notion of last week where the miners, GDX, outperformed gold. So we still have GDX sort of hovering this whole week. It's consolidating, that's good. It brought the RSI down, so it's almost like a high tide flag. Okay, but what we talked about last week was the outperformance of miners versus gold. So we look at GDX, the gold miner index, and gold, the price of gold. And this week, as you can see, it went up and stayed high. So the outperformance of miners vis-a-vis gold is continuing this week. Last week it was huge, but this week it's just a little bit, okay? So it just went up from here to here, not a lot. Okay, but it's good to note that what we wanted, what we were hoping for last week, GDX outperformance on these markets versus gold, is happening and it's staying there. It's real. It's not a one-night wonder, one-day wonder kind of thing. It's not a fly-by-night operation or a one-day wonder kind of thing. So it is persisting. Okay, gold miners are still strong in absolute terms, and in relative terms, it broke these key levels. The GDX broke the 55, which was huge, and now it's staying at around the 58 level. 58, what is it? 58.20 something. Okay, 58.28. So that is good to note, and a good continuation from last week. Okay, and what I also wanted to note is the rare earth element play. Okay, where Trump is literally, the government is literally funding rare earths to be developed in the States because China controls the market. So now we're looking at MP Materials, the number one stock that is going to benefit from this Trump push. So this is still holding at highs and still staying at highs. Okay, I was looking for a pullback, wasn't getting it. However, A proxy to this is UUU, which is energy fuels. These guys have rare earths as well as a uranium play, okay? And it's looking at these highs here, flirting with it, and staying at these levels, okay? Now, this is a great chance for you guys to go long. I'm looking to go long as well. I will be playing this. There's a number of ways to play the energy fuels long, okay? You could just outright buy the stock, but you're open to risk, okay? However, I like to play with options, so you can buy, like if you look at the option tree for UUU, it's you can pull that out anywhere. And if you look at the October expiries is what I like. Okay, I like the October expiries where you can buy the 10. You can play it a number of ways. Okay, I'm shrinking it here so you guys can see what I'm trying to do here. I'm trying to buy the 10, 15 call spread. Okay, the October 10, 15 call spread. Buy the 10s, sell the 15 calls. Will cost you about $1. Okay, so you can risk $1 and you're going to make 5-1. It's a 5-to-1 trade. That's good, but you're going to be risking $1, maybe a little bit more. Okay, you could also do it by financing this by selling puts, maybe the $8 put. Probably if you can sell the $8 put twice, you can make up for that dollar that you spent on this spread. So it'll be a free spread, but you're going to go long. If it ever drops to 8, you're long at $8. Okay, so what you want to do is you want to buy maybe one call spread here. So buy a call, buy the $10 call, October expiry, sell the $15 call, both one, and then sell 2 of the 8s, outright put. Okay, so it's a 1-1-2 ratio. Okay, and that will finance maybe a little credit, maybe break even. It will finance your call spread. Okay, you can just go do the call spread on your own. It'll cost you $1, and you're limited to that $1 in terms of loss, or you can do it for free, but you're obligated to take up twice your position that you took here at $8, and that's like buying stock outright. So it's commensurate to buying stock outright at like 9, but a little bit safer, and done for flat or a little bit of a credit. So the choice is up to you depending on what risk you want to take. You can buy the 10-15 call spread for $1, or do that whole leg, the 10-15 call spread, plus sell twice the amount of puts at $8, all on the October expiry. That's the best thing that I've seen. So this is what I will be doing. Come Monday, I will be buying the spread and selling the 8 puts. So that's how I will be playing this rare earth elements play, which seems to be real because MP is not going down. MP broke to new highs. Hopefully it'll come back down to the, let's mark it here. Horizontal line. Let's mark the highs here. If it ever comes down to $60, I don't know if it ever will. I will probably be buying it as well. Okay, but UUU is a backdoor entrance into the rare earths play. Okay. So that's it. Let's recap. SPY, bullish. Same old. Nothing has changed. I mean, same old compared to last week. It's almost a carbon copy of last week. I just like insert tape and play again. Okay. So bullish. Rates are still going to stay higher for longer on the US 10-year. Don't forget about that. It's not going anywhere. This is the US 10-year. And SPY, we are risking we are at the cusp of a breakout scenario, a melt-up scenario, thanks to the fact that people are still bearish. I guess they keep getting influenced by Twitter. I don't know. But these guys being bearish at all-time highs is fuel for this bull market. Again, carbon copy of last week, climbing a wall of worry. Let's see what happens next week, guys, because that's it for this week.